Yeah. Good morning, and welcome to the American Enterprise Institute. Today we have a wonderful session on community banking in America. What's the future of community banking? But first, we're honored to have remarks by Representative Blaine Luetkemeyer, who serves the 3rd Congressional District of Missouri since 2008. Representative Leutkemeyer is a member of the House Financial Services Committee. He's chairman of the Financial Institutions and Consumer Credit Subcommittee and vice chairman of the House Small Business Committee. Before his election into representative politics, he owned several small businesses and managed a 160-acre family farm that raised hogs and cattle. He spent over 30 years in the financial services industry, working first as a bank examiner and later as a community banker. From 1999 to 2005, Representative Leutkemeyer was elected to the Missouri State House of Representatives, where his colleagues elected him chairman of the State Financial Services Committee. In the current Congress, Representative Leutkemeyer has been an active legislator. The House has passed numerous bills that he has sponsored. These bills put common sense guidelines on the rules that govern bank operational risk capital and the criteria used to designate systemically important financial institutions for heightened supervision and regulation. So please, with me, welcome Representative Blaine Luetkemeyer for his comments this morning.
This looks like a pedestal here. I'm fearful it may rise or fall or something here. Be very careful. But thank you, Dr. Fdic, for your remarks, and it's good to be with everybody this morning. Thank you so much for the opportunity to speak with you. I've been asked to talk about the future of community banking, including my background as a banker and current work as chairman of the Subcommittee on Financial Institutions. So that's a lot to talk about in 10 or 15 minutes, so hope you guys have another cup of coffee or two so I don't put you to sleep. Good morning. Great to be with you again. I see some of the good folks in the audience that have been in front of our committee before, so thank you for your support and your willingness to be a participant this morning as well. Background-wise, I was a bank examiner for a couple of years with the state when I got out of college, and came back home after I got married. Wife didn't quite like the living out of a suitcase lifestyle, and so I came back home, got into the community bank there, and my dad was, at that point, the owner of the bank, and needed some help. Came back home, stayed there, and was in the insurance industry as well for about 35 years, and then was a state rep. And a few years later, they asked me to run for Congress, and here we are. But I've actually been in the banking business since I was 6 years old, because my dad was a cashier at the bank, and the school was only about a block away. And so when I was a first grader, I walked across the street, go up the street to the bank, and I'd actually sweep the floors. So I started working in the bank already when I was 6 years old. And when you live in a town of 300 people, we didn't have a night depository back then. And so whenever people got off work, they would stop by our house and actually deposit, give us their paycheck or have a payment. And so I collected probably more money at the door of our house than a lot of people did at the bank that day. So it was always kind of funny because here I'm 10 years old and I'm still taking deposits and taking payments in. So it's been a long process for me, but it's been great. I've actually really grown up in the business in a lot of different ways. From the standpoint of the committee, obviously most of you know the work of the committee. It oversees the banks, credit unions, payday lenders, mortgage bankers, credit bureaus, as well as all the folks that oversee those entities, the Fed, Comptroller, FDIC, and everybody's favorite agency, the CFPB, or as Mick Mulvaney would call it, the BCF. With regards to some of the issues that we're having with, that we're working on with regards to the committee, our Chairman Pierce and I, Steve's from New Mexico, good friend, we're working on a BSA AML bill. And, it's, those of you who know something about this understand, the banks have really been deputized to become law enforcement officers instead of doing their job, which is to, manage the financial affairs of the community and help grow the community. Now they've got another job to do, which is to help law enforcement to be able to find some bad actors. And in doing this, I mean, it's become a very, very big burden. I've talked to some banks, they have as many as 1,000 employees. It's really the big banks. They spend literally millions of dollars, send hundreds of thousands of these SARs and CRTs to CTRs to the FinCEN folks, and I don't know if there's a big black hole somewhere that they all go into, but I don't know how in the world they can review all of this documentation when it takes thousands of people to produce it, and yet how do you review all that stuff? I don't understand how it works, and I know it's very expensive for the banks, and since there's very, very little follow-up apparently, because it doesn't seem that we're catching anybody with that. It seems that there's more make work for the banks and a lot of expense. And so Steve and I have got something put together that really raises the threshold for SARs and CTRs. Beneficial ownership is the hang up there. It's a big problem. The Treasury came out with a rule. I think it's supposed to go into place this Friday, if I'm not mistaken, where they are supposed to be starting to take information with regards to the owners of businesses and then forward that to FinCEN. So they again have become de facto law enforcement officers by having to collect this information and forward it on. Our bill says, hey, let's take the banks out. They're no longer to be the middleman. Let FinCEN collect this data directly. There's a lot of folks, they think that there's another way that we could do this, which is change some of the stuff with IRS. They collect most of this data anyway. You could change it a little bit to allow some interaction between the two agencies. You could have the states collect it, or they don't want to do that because they think it's an unfunded mandate. So we're in the middle of a lot of discussions there with regards to that, and it's kind of interesting to see how it all plays out. But that's where we are. I think we're getting very close to filing the bill. We're going to have a meeting actually this morning, as soon as I leave here, with Chairman Henschling to discuss where we want to go with it. So shortly we'll know the process of how we want to proceed. Another bill that's important is the data security. This is one that leadership kind of dropped in my lap and said, hey, as a result of all the Equifax and SEC problems of last year, we need to do more with regards to data security, and you are the point person because it falls under the jurisdiction of your subcommittee. So we've been working on it. As you well know, we've had a number of breaches just recently with Facebook, Saks Fifth Avenue, Lord & Taylor, Panera, Delta Airlines, Sears, just to name a few. And I'm sure that list is going to grow as the weeks go by because the bad guys are out there sniffing around in all the different places they can to find the low-hanging fruit of how they can get into the different entities and get a hold of an individual's data to do some mischief with. So our bill really doesn't do a whole lot, but it does sort of set the base and structure of where we want to go with responsibility for the breaches as well as notification for the breaches. Right now, as you well know, there's a patchwork of rules out there that are basically done by the states. And while I'm not a big guy to preempt states, this is an area I think that we need to look at from the standpoint that the patchwork is so all over the place. And there are gaps in this that allow some of our citizens, my constituents, to not have coverage and not have other entities be able to take care of their data in a way that's going to protect my constituents' data. And I think we need to look at that, and this is what the bill will do, have some national standards with regards to notification and to responsibility for the breaches themselves. We've got to remember that we put the consumers first, and when you do that, I think we're okay. One of the things, and this also applies to the government, by the way, with regards to notification, I think it's important from the standpoint that whenever we had Chairman Clayton in front of us, and if you know the story with regards to the SEC breach, that for about 9 months, the previous chairman didn't even know about it, and when she did know about it, about 30 days before she left, she didn't tell anybody about it. The new chairman learned about it about 2 weeks later, and then he disclosed it, and my comment to him was, did he look into this in a way that we could be sure that that information was not used to manipulate the markets? And his answer was, I don't think so. And I said, oh my, I don't think you know what you're doing. So I have great concerns that if we're not looking at it and can't be sure 100% that that information is not being used in a nefarious way, we've got problems. And so, again, I think that the individuals must, the entities must notify quickly. We have in our bill immediately, which really causes a lot of people heartburn. but it really stimulates the conversation. And so we're going to leave it in there for now to make sure we stimulate the conversation, to make sure we get people brought to the table and start talking, because you talk to the industries, they want to wait 2, 3 weeks, a month, 2 months. It's like, whoa, time out. You can't allow my constituents, your customers, to have their information out there and have no knowledge of that and not be able to protect it while you're sitting here doing your thing and playing with whatever you're doing. So that's got to stop. So with regards to the next bill that we're working on is the Senate 2155. We're in the midst of the negotiations with the Senate. As you all know, we sent a Choice Act over the Senate. It was our Dodd-Frank fix. They sent us back their fix, which is, to me it's Dodd-Frank, it's this Choice Act light, but it does help. There's enough good stuff in there. I've got some stuff in there that actually would be very beneficial to a lot of banks, community banks in particular. They've sent us a bill that they said is so perfect that it can't be moved, it can't be touched. There's a perfect bipartisan negotiation that's gone on here. That as a result of this, this is the perfect bill we should never ever do anything with. All of you know that this is a bunch of baloney. There is no bill that's perfect around here, yet they want to have us not touch it. So we are negotiating with them to try and explain to them that we've got a lot of bills in our part of the building that they sent us a bill that had 2/3 of their members' support. We have a lot of bills that we passed over the last several months here. We took the big bills, broke them in little pieces, and we got about 30, 35 bills that have bipartisan support, huge bipartisan support, that have got 2/3 of our members, a bipartisan number, to support those bills. So we're working with perhaps putting a package of those together and then getting the Senate to accept that package. And so there's some negotiations going on. I know the speaker yesterday morning at his press conference indicated that there's progress being made along those lines, so I'm not talking out of school here, but I think there is still some concern about timing, how this is all going to work. I'll be glad to answer any questions on it you want to have, but I think that at the end of the day, we're still working through that process. We don't want to kill the bill, anything like that, but I think it's an opportunity for us to also put good bills, little bills out there that can make a difference. I know when I talk to banks, especially community banks, their comment whenever I ask them the question, what's one rule, one regulation that if you could wave a magic wand, it would go away? And their comment always is, Blaine, it's not any one particular one. It's this accumulation of all these rules and regulations. It's like straw on the camel's back. As sooner or later, you can't bear the weight, you can't bear the cost. And it's just driving banks out of business. And as you well know, there's one bank and credit union a day leaving the industry, being merged or just walking away. So we've got a big problem with regards to access to credit, as well as the cost of credit and financial services as a result of Dodd-Frank. So it's important that we pass this bill. It's important that we start taking some of the straw off the camel's back. And we in the House have got a lot of little bills that will be just like that, to be able to take some of the straw off the camel's back. And so that's why it's important we continue to push for that. With regards to the future of community banks, we can talk about this all day, and this is just some of my thoughts, and they're kind of random thoughts here, so bear with me for a little bit. But I think you start with financial regulation. I think the administration has had a chance to put a group of new regulators in place. I think you got one more to go, which is the Fdic chairman. And I like their choices so far. I think they've done a good job of putting some good people who are folks who have backgrounds in banking. They're not economists. They're not individuals who are academics. They're people who actually have real-world experience and understand the interaction of the bank in a community. Understand that the bank sometimes is at the heart of the community. I know as a bank examiner, you can always tell the ability of the banker to be participant in his community by just driving into town. When I drive into town and you would sit there and you see lots of activity going on, you see new homes, new businesses, the hustle bustle of the community, you say, man, this guy's investing in community. And sure enough, you go look at his loan portfolio, he was taking risks, he was investing in community, there's lots of stuff going on. But if you drive into town, there's nothing going on, there's dust blowing down the street, tumbleweeds blowing down the street, and you look at the loan portfolio, lo and behold, you'd see that he didn't have a loan portfolio. He was usually going and at that time, he was going to the post office to pick up an interest check on his T-bills. So you can see that just by viewing the community, whether the banker was an aggressive individual who was participating in the growth of his community and therefore the growth of his bank, whether he was sitting on his money or his community and not doing a whole lot. So I think from that standpoint, the tone of the regulators to be able to work with these banks, especially community banks, is very, very important to sort of take off some of the the burden of some of these rules and regulations that were put in place by Dodd-Frank, because Dodd-Frank was not meant for the community banks. Again, they were part of the solution, not part of the problem. They were roped in to be part of the problem, and I think the regulators understand that. They're trying to find ways to reinterpret and to redo some of these rules and regulations so that there will be some clarification as to who and where they should be applied, which banks, and from there allow the community banks to be able to exist. Competition, I think, will drive a lot of the things with regards to the community banks over the next few years. Financial, we've had a good conversation with Rebecca a while ago in one of the back rooms here, and we were talking about the fintech folks, and I think there's both good and bad with regards to that. I think from the bad standpoint, they're not usually in a position to be able to afford to purchase the fintech companies, to be able to have a license on those particular products. But by the same token, as technology continues to improve, I think there will be a sharing of those things, or the fintech companies themselves will be able to partner with the community banks, and I think that will help them, quite frankly, be able to compete. I truly believe that there's going to be a place for the community banks in the future. There's a lot of competition out there right now with big banks and credit unions and farm credit services, but I think there still is a niche. I've had this conversation with Jamie Dimon before, and Jamie said, look, where you live, Blaine, I really don't want to put a facility. I don't think, my business model is something that doesn't work where you are. So there is a niche that's there for community banks. I think 50% of the small business loans are made by community banks, small banks. I think that figure's right, and I think they only have 14-15% of the deposits. I don't know, that's pretty close, Tom, somewhere in there. So I think it's disproportionate. You can see that there's a place for them. I know as vice chairman of the Small Business Committee, we had a guy in our committee one day, was a small businessman, and he's sitting there, and we were talking about access to capital. He said, Congressman, small businesses get their loans from small banks. And so they understand what makes a community great. I can tell you, from coming from a small community of 300 people, if my bank is not involved in the community, my bank doesn't grow. And so one of the jobs when I came home was to get involved in all the community activities, be a part of that, so we could make sure the community went in the right direction. And as a result, the community was able to grow, my bank was able to grow, and we all worked together. But I really think that there's a niche out there for the community bank. I think they're well managed. I think if you are aggressive, if you are willing to be open-minded and participate in a lot of the new products, I think you're going to be successful. There's concern about the millennials and all their everything has to do on a phone. I saw some numbers the other day that indicated that they may be reaching a peak. There's still a place for that personal relationship that comes whenever you want a loan, whenever you want different certain services that only a bank can give you whenever you go in and look across the counter or across the desk with somebody. So hopefully I've stimulated a few questions from folks. I'll stop right there and be glad to answer them. And again, thank you for the opportunity with you this morning. It's been fun, and look forward to your questions. Dr. Kubiak.
So we'll have some questions for Congressman.
Congressman, thank you for being here, and thank you to the AIE for hosting this conference. Congressman, a real quick question. You had mentioned, the partnership of community banks with fintech.
Yeah.
There's some challenges associated with how the regulators are actually interpreting some of the current laws, specifically deposit brokering. The definition really is from a standpoint of any third party that it facilitates the placement of deposits could be a deposit broker. And so if you look at it, any fintech that works with a community bank, potentially helping them attract new relationships, could be deemed a deposit broker. I would encourage you to look at Bill number 2793 that was introduced by Roger Williams and Gwen Moore that addresses that issue.
Okay.
Thank you.
No, I think you're right. I think, as I said, the regulators are going to have to look at the rules differently to be able to allow community banks to exist. Dodd-Frank was a perfect example. The rules are meant for the big guys, yet they're being applied to the little guys. We've got to find ways to get exceptions to those rules or allow the community banks to be able to, again, partner in ways that are going to be helpful to them. But we'll be glad to look at it. I'm off the top of my head. I can't remember. I know we've done some work with regards to reciprocal deposits and brokering deposits, but I'm not familiar with. Yeah.
But if you also look at Section 202 in the Senate 2155, which it deals with reciprocal deposits, there's a way to actually add language out of 2793 directly into that piece.
Okay.
So it's a very, very powerful bill. It's very simple. If the account is opened by an individual, fully insured, used by
Has
that
the bill
individual.
gone through committee yet?
It has. I do not believe it has. It's been
Okay.
introduced, but it not.
Okay.
It has gone through a hearing
Okay.
2 years ago.
Okay. Very good. Thank you.
Yes, sir.
Great thought. Anybody else?
Congressman, one of the issues that I think just
I believe in lots of capital.
well, but do you really? Because here's my issue for the community banks. They have the capital you want. The largest banks do not. It gives the largest banks a 400 basis point advantage in cost of capital. Regulatory burden is one issue, and I've made many of the proposals that you guys are looking at in terms of reg relief. But if you don't level the playing field and the cost of capital over time, you're going to lose every time when you're at that kind of disadvantage. And how I know the choice bill put that in there, but it also left the largest an opt out, which I think is where the advantage will never go away, and it's something at least to be aware of and consider.
I don't disagree with you. I'm with you on, as a former regulator, and somebody who's, in the business as well. The more capital, the better. We don't, if you have enough capital, you don't even need regulators because you're sound enough that you're not going to be a problem. But yeah, finding the sweet spot on that, and I think I'm with you. I think we've got to be very careful on the capital requirements. Part of it is the business models are a little different. So how do you apply the capital requirements to some of these different business models? It makes it a little dicey sometimes to get that done. But I'm with you. I understand. You're right. It does give them an advantage. And this is why the regulators need to be able to allow the community banks a little more leeway on some of the other rules and regulations that give them an advantage whenever they're looking at that because of this cost of capital problem. Thank you. Good point.
Congressman, I'm going to follow up with one question, and it's kind of a tough one. I've been in bank regulation for 30-some years, built internal models, worked at the Federal Reserve, worked on all the complex rules. The complexity of bank regulations is just off the chart. When we get regulatory relief, like we have these proposals from the Federal Reserve Board, they add to the complexity. They don't reduce it. The new add-on leverage ratio for this, it's another thing they have to calculate. How come the Congress, can't give the regulators some push to really, simplify the laws, bring them down to common sense? I mean, when you need a PhD and 3 days to read a new rule and a regulation, and then still need to hire Ollie Ireland to understand what it really means, there's something wrong with the system, don't you think? I mean, isn't there a way we can push the regulators to bring it back to common sense terms?
Well, one name, Elizabeth Warren. It's very difficult to get any sort of change whatsoever through the Senate. I mean, we can pass a lot of stuff in the House, as you well know, and this is why our Choice Act didn't go anywhere. It goes to the Senate, and she just strips the bark off all of her members over there, and they finally, bucked up enough against her to pass 2155. And so it's very difficult to get change. She wants more regulation, not less. She's in a position as being a senator that she can really, it takes 60 votes to realistically do anything in the Senate anymore, whether the Republicans are in charge, Democrats are in charge, still takes 60 votes to get anything done. And so until one party or the other gets 60 votes, it's got to be a bipartisan deal, and it really empowers her and the minority in this situation. And so as a result, it's very difficult. But you make a great point from the standpoint that, there's just a lot of very cumbersome rules and regulations. I had a banker the other day that made a point to me, and I really think it hits home on all the rules and regulations stuff. He said, Blaine, do you realize that somebody can walk into my office and they want to make a $50,000 car loan? And I said, my paperwork is about this much, take about 60 to 90 minutes. It doesn't cost them anything. That asset is mobile and it's depreciable. Now that right after he leaves my office, there's somebody can walk in and want a $50,000 home loan. Paperwork is this thick, takes 60 to 90 days, probably cost them an average $2,500 to do the loan, and that is an asset that is appreciable and not mobile. What's wrong with this picture? What's wrong with that picture? We have gone from an asset that doesn't go anywhere and appreciates and you need this much paperwork and cost on top of that to one that is depreciable and mobile and you need that much paperwork. We're all out of whack. We're totally out of whack. And so we've got to find, as you said a while ago, some common sense in how to do this, and it's very difficult to rein this in and find ways to empower the consumer again to be able to be in charge of this, because at the end of the day, they're the ones who have to pay the costs. They're the ones who make the decision whether they do or do not want to borrow money. They're the ones who got to figure out how to pay for this. Now with the tax cuts, they get a little bit more money in their pocket to actually do this, and you've seen some activity. But it's a big problem. Regulation is just, I deal with it every day, pull my hair out, what's left. And so it's there. Yes, sir.
One observation. You described taking, in your small community, people coming by your house to leave money for deposits. In today's world, a community
pass the banking bond, would it?
Doing that would be willfully operating an illegal branch and would be violating, bank would be violating the law, potential sanctions against the individuals involved. And that's the supervisory climate we're in.
Yeah.
And there needs to be some return to common sense, not only in the regulatory structure, but in the administration of the regulatory structure through the supervisors. And I'm not sure, I came out of the Federal Reserve, I used to work with Paul. I'm not sure what the method is, but something needs to be done to reorient that process to make it focus on risk as opposed to focus on mechanical rules.
Well, you've hit the touch point there with risk. I mean, we've gone through a period here of trying to de-risk everything. And I always tell people, if you de-risk everything, one of two things happens. Number one, if you de-risk, you're no longer taking risks in your community, and your community is going to dry up. Or if you de-risk totally, where's the risk shift to? It shifts to the government, which is all of you. The taxpayers are now on the hook for all the risk. This is where the risk needs to be. Risk needs to be in the private sector. They do risk analysis every day. That's the purpose of, that's the job that bankers have, to assess risk. I screamed this from my committee. Peter, you've seen me before. When I screamed this, I said, look, it's about the banks analyzing risk. That's their job. If you take that part away, where's this risk go to? There's still going to be risk someplace. And in fact, had breakfast yesterday with Dr. Corson. And there's a move within Congress, as well as right now with the GSEs, to get some of the risk off the books with regards to putting some reinsurance in place. And I asked him if he's looking at trying to do that as well. I said yes, but I think that's where we need to go. We need to shift the risk to the private sector. The government, all of you, don't need to be on the hook for everything that's out there. The private sector needs to be on the hook for their decisions. And it kind of drives me crazy all the time when I'm sitting there, and the other side especially wants to sit there and give away this, give away that. The government can do this, government can do that. I'll just guarantee it. Well, who's on the hook when you guarantee something? There still is somebody on the hook, and they don't understand that. It's just, and then the people on the hook are all of us. Thank you for the question. I appreciate the comment. Anybody else?
We have time for one more.
One more. You're an easy group this morning. If not, thank you very much. Great to be with you today. Take care.
So, on with the show. With the panelists, when you get a chance, join me. In 1921, there were more than 31,000 independent banks in the United States. All but a handful were small institutions. Most had only one branch. The 1920s were hard on American farmers, which translated into hard times for community bankers. Between 1921 and 1929, 5,709 banks closed their doors, bankrupting many state-sponsored deposit insurance schemes. For banks, the 1930s were even worse. Between 1930 and 1933, 9,096 banks closed. Again, virtually all community banks. By the winter of 1933, a nationwide banking panic had taken hold. To stop the panic, the newly inaugurated President Franklin Roosevelt declared an extended bank holiday, which he explained in his first radio fireside chat. A few months later, Congress created temporary federal deposit insurance, which subsequently made permanent. The government response stabilized the banking system, and bank failures declined. The early 1960s brought a different problem. In 1963, when Wright Patman, then chairman of the House Banking and Currency Committee, dedicated the new FDIC building, he said, "I think we should have more bank failures. The record of the last several years of almost no bank failures, and finally last year, no bank failure at all, is to me a danger signal that we have gone too far in the direction of bank safety." Imagine that. But bank failures are only one side of the community bank story. There were, of course, many mergers as the industry consolidated to adjust to U.S. demographic changes, new technologies, and new state and federal banking laws. Throughout most of the last 75 years, a healthy number of new banks, community banks, were started each year. But the financial crisis changed that dynamic. Between 2011 and 2016, there were only 2 new bank charters. In 2017, there were 5. If Wright Patman were alive today and speaking at the FDIC, he might say, "I think we should have more new banks." The record of the last several years of almost no new bank charters, and finally last year just 5 bank charters, is to me a danger signal that we have gone too far in the direction of bank safety, too much regulation. I have taken the liberty of producing a map that shows the change in the number of independent banks state by state, and if there's a clicker, can somebody click it? We should get the next slide. That's not a clicker. Where's our clicker? We're short a clicker. Is that it? Okay, one more. There's a map. This is the number of independent banks between the change in the number of independent banks between December 1994 and December 2017. Now, as a consequence of bank failures, mergers, and new de novo entrants, the average state across all states saw 54% of its individual banking institutions disappear. Only Utah and Nevada sort of didn't have the same fate. Will this trend continue? Is the end of community banking inevitable, or will community banks adapt and continue to be an important part of the U.S. banking system? Will new technology and the so-called Fdic revolution be the savior of community banks or hasten their demise? Do the waning numbers of community banks have implications for the availability of small business credit and economic growth? For answer to these and other important questions, we turn to our panel of experts. And I'm going to introduce our panel of experts, and it's in alphabetical order rather than the order they speak. On April 30th of this year, our panelist, Dr. Thomas Honig, completed a 6-year term as vice chairman of the FDIC. Prior to that, he served for 20 years as president and CEO of the Federal Reserve Bank of Kansas City, where he was a member of the Federal Reserve Open Market Committee responsible for setting U.S. monetary policy. Mr. Honig is an expert on community banking and bank regulatory policy. He holds a doctorate degree in economics from Iowa State University. Oliver Ireland is a senior counsel at Morrison & Foerster. Mr. Ireland is widely recognized as an expert in banking law. He focuses on a wide range of issues involving payments, retail financial services, and bank regulatory issues, including regulatory issues for chartering new banks, states, and bank holding companies, and credit unions. Rebecca Romero Rainey is the new president and CEO of the Independent Community Bankers of America. She is one of the nation's foremost advocates of the community banking industry and has met with 2 presidents to discuss community banking issues. A 3rd-generation community banker born and raised in Taos, New Mexico, Ms. Rainey is the former chairman and CEO of Centennial Bank of Taos. After graduating from Wesley College, she returned home to Taos to help run the family business, the town's only local community bank. And all I had was a paper route. In 2007 and 2008, she served as president of the Independent Community Bankers Association of New Mexico and as the first chairman of the ICBA's Minority Bank Council. She was a member of the Federal Deposit Insurance Advisory Committee on Community Banks and the Kansas City Federal Reserve Community Bank Depository Institution Advisory Council. Last but not least is Professor Dick Silla. Dick is a retired professor from the Stern School of Business, New York University, where he was the Henry Kaufman Professor of History of Financial Institutions and Markets. He is a research associate of the National Bureau of Economic Research, a fellow of the Cliometric Society, and a fellow of the American Academy of Arts and Sciences. Professor Silla earned his PhD at Harvard University. He's a prolific author. By my count, he's written at least 9 books and an impressive collection of articles, essays, and reviews on business, economic, and financial history. He's been the editor of several important journals, economic history and business history related. He's been the president of every association, and though, well, I don't think Dick has ever been on Dancing with the Stars, he currently serves as chairman of the board of the trustees of the Museum of American Finance, which is a Smithsonian affiliate museum located at 48 Wall Street in New York City. And I'm going to turn the show over to Dick. You can, audio? Yeah, I guess so. I think so. This is a big one. Yeah, try.
Well, thank you, Paul, and thanks to you and AEI for inviting me to be here. If you're an economic financial historian, one nice part of it is that you get to speak early in the, because you're going to talk about the past. And that's what I want to talk about. I actually want to go back sort of before Paul started. He said, he mentioned around 1920 there were like 30,000 independent banks in the United States. And this was very unusual compared to most countries in the world because most countries in the world, they may have had more banks early in history, but they got to be fewer over time, and big branch banks, if you think of the Canada, just north of us, with a lot of traditions that are similar to ours. They have a few great big banks with branching nationwide, and we had these thousands and thousands of banks. I would say, as a historian, I want to talk about how we got up to 30,000 banks. As a historian, I'd say, in a sense, almost all banks in the United States were community banks when they started. That is, they were in a particular community, and people in that community got together to found the bank, and then they did a lot of local business in kind of the way the congressman described community banks. But there were certain trends in our history. I think the data, and let me see, I had a couple slides. I don't know if they're going to show up very well. Ryan told me yesterday. Yeah, here they are. This is actually, it's a little bit fuzzy, I guess. It's a little bit fuzzy. I have my own copy here that I can talk about. But, and let you in on a little secret, this is from a paper I wrote 38 years ago. The data may have changed a little bit as historians improved it. But a couple of points I want to make in this table, which is the commercial banks in the United States from 1782 to 1920. Well, you see the number over there in column 2. It goes in 1782, there was just one bank in the United States, the Bank of North America in Philadelphia. 1790, there were 3. And there's some data on the capital stock of the average capital stock of these banks. And what you see how the American banking system grew up to 1920, from 1 in 3 banks in 1790 up to 30,000. But there's certain periods where you see the growth is a bit faster, like from the, I would say from the 1830s to the 1860s, there's a kind of rapid growth of 300 and almost not quite 400 banks in 1830 and about 1,600 chartered commercial banks in 1860. The numbers in parentheses try to take account of some estimates of private bankers. Private bankers were bankers who hung out their shingle and became bankers without getting a charter from a government. And the estimate is that in 1860 there might have been about 1,000 of these, so there were maybe 2,700 banks in 1860. I draw your attention also to the average paid-in capital stock. Early on, the average bank had about $300,000. These numbers sound rather small today, but it's back in an era when money was worth something. So $300,000 was a pretty big business in the early United States. And you see that sort of from 1800 to 1835, the average capital was in the vicinity of $300,000. And then you see something that is sort of surprising. After in 1850 and 1860, it actually drops. The average bank becomes smaller. You would think in a growing economy that the average business would get bigger, and that was certainly true in things like manufacturing. But in banking, the average business got to be smaller over time. Well, what happened was in the 1830s, late 1830s and 1840s and 1850s, the United States introduced what was called free banking. And basically they shifted from the early model where if you wanted to be a bank, you had to go in individually and get a special act of the state legislature to become a bank. This got to be known as a fairly corrupt system because the banks that were already in the field wanted to keep out other banks, and the banks that wanted to get into the business of banking would sort of bribe legislators to get their charters approved. Anyway, it was kind of a restrictive system, and the bigger banks thrived. But the corruption got to be such a problem by the 1830s that New York was the first to introduce free banking, which shifted the chartering of banks out of the state legislatures and into the administrative function of government. The law said if you meet certain specs, 5 people get together and agree to some provisions of the law, then anybody can become a banker. And so we had free banking. And during the Civil War, we introduced the national banking, which was trying to get rid of some of the chaos that resulted from these 1,500 or more, 1,600 or more banks, each issuing its own currency, 4 or 5 denominations of notes. So the country was flooded with various different kinds of looking money that was all supposed to be convertible into the base money of gold and silver dollars. In the Civil War, the Union had a need to sell bonds, and so they decided to introduce national banking. The national banks had to back their currency issues with U.S. government bonds, which helped the Union finance the Civil War. And basically, we converted from having all the individual banks issuing their own notes to having all paper currency be, in effect, the liability of the federal government, backed by bonds. And they thought at the time that the American banking, this is a lesson in regulation, they thought at the time that American banking would become all national banking. They thought the old state banks would shift to be national banks. Well, they didn't do it. Some of them thought they didn't want to change their names and all that. And so a few state banks survived after the government put a tax on state bank note issues. Basically, they made it impossible for state banks to issue notes. And they thought that all the state banks would be forced into the national system. That didn't happen, partly because, and this is where regulation could go wrong, the national banking law had high capital requirements for banks. It said you couldn't issue any agricultural loans, and there was actually a note issue ceiling on the early days of the national system. Anyway, you had an over-regulated national banking system, and that's what really marked the entry point for all the banks that started to be formed in the 1880s to 1920s. If you look at the data, you see, in 1880 there are like 5,000 banks, and in 1890, 10,000, 1900, 12,000, 1910, 24,000, 1920, 30,000, the number Paul started out by mentioning today. And the capital per bank went down, down, down. And so instead of having banks having $300,000 of capital on average in the early 19th century. By the early 20th century, the banks had 1/3 of that. They had about $100,000. This was the golden age, I would say, of community banking. The second slide, again, the numbers are fuzzier than they should be, will show you that what happened. Actually, by 1920, the state banks outnumbered national banks by 18. They had 22,000 state banks and only 8,000 national banks. And the deposits of the state banks actually exceeded the deposits of the national banks. 18 billion, I guess, down to 14 billion for national banks. And so the only places in the country where the national banks outnumbered state banks were New England. There were four, not by much, 409 to 399. And in the middle Atlantic states. These were, the national banking law was good for those states, but it wasn't good for the rest of the country. It was too restrictive. It was kind of a northeastern law that didn't apply when the country was moving west. And so the great failure of the national banking system had a goal of making all banks national banks, and because it was over-regulated, you had this remarkable recovery of state banks in the late 19th century. Well, how did this banking system work? That's an interesting question. There's a lot of coordination issues if you have so many banks in a system. Much easier in another country like Canada with 5 or 10 big national banks, nationwide branching banks. Much easier to coordinate banking. In the United States, the bankers came up with, in the economic sense of coordination, a correspondent banking system. The small banks held money in larger banks. The larger banks held money in still larger banks in New York City. It worked very well, and the larger banks would provide collection services for the smaller banks. I think it still goes on to some extent. There are relationships between banks. But remember, this was an era when there was no central bank, and so the bankers had to develop a pretty good system, I think, of coordinating their operations. They also wanted to have a political voice, so by the 1870s, they formed the American Bankers Association to give a voice to their, they had to go to Washington and lobby and so on. So they coordinated economically and they coordinated in the political sphere. Now, I was going to say that Paul mentioned that, that in the 1920s there were a lot of failures of these small banks. Many of them were in agricultural towns, such as the one the congressman described to us, 300 people. So there were lots of failures then and lots of failures in the 30s. I think the number of banks in the country was roughly cut in half between 1920 and 1935. And then it stabilized. I remember when I was young, it seemed like we had 14,000 banks or so every year, from the 1930s to the 1970s. The government had come in and kind of I better have a drink here. Cartelize the system. The fear was of bank failures. So let's not have any bank failures, and the way to do that was to have a heavily regulated system. And so the number of banks didn't change. I think some left and some entered, but we had about from the 1940s to the 1980s, 14,000 banks. And then we had the deregulation, so the last 30 to 40 years. And then numbers started to go. I think 30 years ago, there might have been 10 or 12,000 banks. And that now we're down to 5,000 or so. And the decline is likely to continue. But my personal view is that community banking will survive in this country. And I don't know if it's going to thrive, but for a couple of reasons. One is that there's an ideology of small business. And in the United States, and that's the history shows that, and I think that continues. The congressman kind of hinted at that, and I would, as in probably getting to the end of my time, I would just quote a Secretary of the Treasury in the 1830s when this transition was going on toward freer banking. His name was Roger Taney. He later on became a Supreme Court justice and was infamous for the Dred Scott decision in the 1850s. But in the 1830s, Roger Taney was Jacksonian and Jackson's Treasury Secretary, and he sort of announced the triumph of this new order of banking when he said, quote, "There is perhaps no business which yields a profit so certain and liberal as the business of banking and exchange, and it is proper that it should be open, as far as practicable, to the most free competition and its advantages shared by all classes of society." Well, I think in the century or so after Tawney said that, you could see all classes were sharing in this tremendous expansion of community banking, and I think that spirit is still out there. There are people. Here's what's going to happen in the future. I don't know how many community banks will be, but it's my impression that there will always be people in some community who think they would like to start a bank. And they may sort of feel like the community isn't being well served by a branch of a huge bank that's far away. Or it may be the community isn't being served much at all because of what the congressman mentioned. Jamie Dimon doesn't think it's part of his business model to put a bank in this small community. So there'll be people who want to start banks in communities. And often these will be people who want to borrow money from the banks. When I was really young and naive, I thought banks are started by people who have money they want to lend. But I discovered rather quickly in studying banking history, no, that's not true. Banks are almost always started by people who want to borrow. And so there'll be local entrepreneurs who will see advantages in being able to borrow from banks. That was true right from the beginning. That's what the first banks did. And so on that side, there'll be a supply of people wanting to come into banking. On the other side, there'll be people in a local community who, again, as the congressman said, will like to deal with somebody they know, somebody in the community they know. They'll prefer a local community bank that seems personal. Maybe you play golf with the banker, maybe you go to church with the banker and all that, and you feel good about it. And in the same way, you don't feel like you like to go in and get your banking done by a branch of a bank that's far away, where I've had this big experience myself, where the people in the smaller towns say, well, we have to follow certain rules, we have to call up someplace far away to decide whether we can make you this home equity loan or something like that, where it could be arranged much more personally. So I think there's, American banking has a community banking has a future before it. I just don't know quite what it'll mean in terms of the numbers. Well, thanks a lot, and I hope that provokes a little bit of historical thinking. That's my job.
Tom?
Well, first of all, Paul, thank you for the opportunity to speak to the group this morning and to talk about community banking. It is a topic that is near and dear to me. I've been working in the area for more years than I'm going to disclose, and I do have some thoughts. The first thing is to admit I don't know what the future of community banking is with certainty, but I do think I have a sense of some of the forces that are going to affect that future, and how we address those forces will define whether community banking is prosperous in the future or continues to consolidate or even struggle. I think, first of all, though, the community banking model is a very viable model. It's based on relationships, based on knowledge that is local, but also able to provide for expansion at that local level. It relies on a source of funding that is local or at least deposit focused, and it is focused then also on lending within a knowledge base that they have a very good advantage on in that community. So the model is a good model, but there are the forces that we talk about that I think we need to be aware of, which are the regulatory burden that has been mentioned and also the relative cost of community banking versus other banking models. How do I know and how am I confident that it is a good working model? Well, if you look at today and consider it, the banking industry, the community banking industry is doing very well. Its profits are at historic highs as an industry. It has strong return on assets before taxes, better than 1.3%. It has loan growth that is consistent, 8% growth on the average of the last 2 or 3 years. 40% of business loans, very strong in the commercial real estate business, and with good returns. It has, in terms of asset growth, those loans support asset growth, obviously, and that asset growth has been consistent. So it is a viable model, and that, I think, is very important. Now, the difficulties are the challenges that are continuing to confront the community bankings. There's short-term challenges, which every industry faces. There's liquidity challenges, especially now with strong demand, and in some areas like rural areas where agriculture is still under pressure, liquidity becomes an issue. But those are things that banks deal with. Interest rate risk is there. It's always there. And so we will have that. That's not going to be the demise of community banking. And those are the things that we realize, we address, but that's not the defining factor. I would say, though, that in the area of regulation, it has been a very significant factor going in the past and will be a significant factor going forward. And we always talk about the community bank and the need to provide regulatory relief, but it very seldom happens. As I think others have already mentioned, you might design the regulation for a particular part of the industry, but it tends to fall on all the industry, including the commercial banks, and disproportionately, in terms of cost per dollar of assets, more heavily on the smaller bank. And that means a competitive challenge that is very difficult to overcome. And I think we need to be aware of that. Some of the things that I think can be done to address that is the fact that, and you see it in the Senate bill and in some of the Choice Act provisions or in their individual bills. I think the description that the congressman gave in terms of a local bank or even a bank in an urban area where the management does have greater discretion to take risk based on that customer and the knowledge of that customer has been compromised greatly. The rules are arcane. The lending is such a process. If you are involved with a third party, you are responsible for that third party. You're not just doing business with it, but you are responsible for the behavior of that third party. That puts an enormous burden. You mentioned the fact that we're now asking the community bank and all banks to be the police extension of the enforcement sector of our government. That is very difficult and very expensive. So those are things that we need to address. And some of the bills do that. I think we've seen in the present proposals relief around the mortgage disclosure. Yes, we want to protect the consumer, but we have grown that disclosure requirement to curiosity questions as much as real consumer protection questions, and I think we need to be very mindful of that. And so with that going on, and not really addressing it, it's tied up. If you look at the Senate bill, it addresses some of these issues, mortgage disclosure, the rules around lending for mortgages and so forth. But at the same time, it has provisions that provide significant relief in the sense of other requirements for the larger institutions. They get all balled up in this. And that's why it becomes much more difficult to pass in either the Senate, particularly, and even some aspects in the House. The second thing is the cost of capital, which I asked the congressman about. If you think about it, and you require, or the market requires, a 10% capital for community banks and a 6% capital for the largest banks, you're not going to win that game. Cost of capital really matters. We don't think about it sometimes, but in your pricing of loans, it does matter. And in your pricing of your business, it does matter. And I'll give you one example, not in a rural area, but in a metropolitan area. So a community bank builds a business, makes the loan to the smaller. It performs over a number of years, perhaps, months or years, and then the larger bank can outprice them and take that loan whenever it chooses to. That is a very difficult competitive position to be in, and I think we need to be mindful. It's not just because of the size of the loan that goes to the larger bank, it's the pricing of the loan once they know it's a safer loan. So what's been the effect of this? Well, we've seen it in the chart that was just shown, right? The consolidation of the industry. Now, the crisis was responsible for about 500 community banks failing, but between 2008 and today, over 1,500 community banks have merged. So a lot more than the failure rate. And so what's driving that? Well, this cost of regulation and this relative cost of capital. And that is going to continue unless we do something about it. And that's why I'm a very strong supporter of the reg relief for the community bank. And I'm also a very strong supporter of increasing the capital requirements on the larger institutions so you have a level playing field. I don't think we're going to lower it for the community bank. And yeah, the congressman said it is complicated, but here's one thing I want to describe to you. If you think of 10% capital, which is in historical context not particularly high or particularly low, and you apply that across all banks, all commercial banks or related to commercial banks, and you would see that for the largest 20 banks, that would require about $500 billion more in capital. And for all the other banks to get that would require about $85 billion. That's for the other 5,200 banks would cost that much. And for the largest, that's the difference in the subsidy, if you will, that they have. And I think that's very difficult to compete against. If you then remove some of the regulatory burden and simplify those regs, and it can be done, and you make the condition that we all have an adequate amount of capital so that the fallback to the taxpayer is far less, then I think you have an opportunity for the community banks to survive. Now, there's one other set of factors that you cannot ignore, and I know will be in play here, and that is the market itself. Technology is changing the competitive landscape. The community bank has to be aware of that, has to deal with that, and if they're allowed to, I think can successfully deal with that, as we've seen in history. But if they're not, then technology will force further consolidation. And I think we really need to be mindful of that. So when the market is allowed to play, and we do have requirements of reasonable capital, and we have confidence in the private sector, then I think the community bank is a tremendously successful model and can and will provide future growth for the U.S. Going forward. If we choose not to, and we keep giving lip service to the importance of community banks but no real relief, then I think the challenge for the community bank is really going to be a difficult one going forward, and we'll see it shrink further, and these activities, as the professor described, being shifted elsewhere. And I'm not sure that will be in anyone's long-run best interest. So I would leave you with those thoughts as we look to the future of community banks and finance. Thank you.
Oliver Ireland.
Thank you, Paul. I'm going to speak from a little bit different perspective. We've had some history, and Tom is a senior official at the Fed and the FDIC for a long time, sees the big picture. I'm a plumber. I deal with micro transactions. My world, I came out of the Fed. I'm in private practice now, but my world is making things work, making transactions work. And in the community bank world, I'll start with the story. Years ago, when I was at the Fed, this was late 98, early 99, and the American Bankers Association every so often, would bring in state bankers associations, and they would come into the boardroom at the Fed, which is a huge, impressive room with a, 30, 40-foot table or something. And one of the governors would meet with the State Bankers Association. They'd give a little talk about monetary policy issues they saw, and then have questions and answers with the states. And this case, the State Bankers Association was Montana, and Alice Rivlin, who was vice chair, was speaking to them. And the Travelers Citibank merger, this was pre-Graham Leach-Bliley passage, was announced, and there was a concern about creation of big financial companies. And so Alice asked the Montana bankers whether they were concerned about that. And nobody said anything. And Alice, being Alice, asked them again, aren't you concerned about this? And finally, a banker in the back of the room, that way down at the other end of the board table, because they used to sit at they now sit in the middle of the table, they used to sit at opposite ends, raised his hand and said, you put two big rocks together, there's a gap between them. You put two bigger rocks together, there's a bigger gap between them. We live in the gaps. I think that's true. I think those gaps are going to be there. I think that market's going to be there. And the only question is, are we going to kill it through economic conditions or the regulatory structure that we are fostering in this country? Now, some of that structure that's resulted in a reduction in the number of banking organizations, things like interstate banking, I don't think that's going back anyplace. I don't think that's going to change. I think there are a number of factors that can be changed, and there are a number of ways that they can be changed. First of all, as I think has been pointed out, the regulatory structure is mind-numbingly complex. And a community bank on its own can't comply with the regulatory structure. It can't do it. The costs to understand that structure, let alone put in place all the compliance mechanisms necessary to do it, are prohibitive. There are a lot of banking is manipulation of data, keeping track of records. There are enormous economies of scale in that area, and they need to be able to take advantage of those economies of scale. The technology necessary to comply and to provide services, the competition with fintech, which has been mentioned earlier, community banks are not going to be able to develop those technologies that their customers are going to want to get services going forward all on their own. They're going to have to use service providers in order to do that. They're going to have to partner with fintech companies. Those fintech companies can, and other service provider companies can bring regulatory expertise and compliance to the banks because they can spread it over a broader number of bank customers through multiple banks and reduce the costs. They can produce economies of scale in processing, transaction processing, information processing, and they can bring the tech knowledge and the tech investment that the individual institutions can't do on their own. There are problems, serious problems in the banking structure system and the banking supervisory system on companies using service providers. Somebody brought up earlier the FDIC's deposit broker rules. I was at the Federal Reserve during the Thrift crisis, where the deposit broker rules came in statute in FIREA in 1989. I lived through that in a very real way. closing banks right and left. Brokered deposits were a big problem in that time. The brokered deposit rules that are applied today are applied to transactions that had nothing to do with the brokered deposits that were a problem in the late 1980s in Texas. It's a system that's out of control. On the consumer compliance side, all the rules are incredibly complicated, incredibly difficult. If a bank contracts out those services to a service provider, the regulators come in and supervisors come in and they tell the bank, you have to oversee what the service provider does and you have to know they're doing it right. The problem is you're contracting it out because you can't do it on your own, because they're better. The reason you contract it out is they have comparative advantage not only in tech but in expertise, and the idea that you know as a community bank whether they're doing truth in lending 100% correctly is a fantasy. Somebody has to rethink the oversight of service providers and community banks and how those work together. There are problems with that model also just from the current oversight of service providers. The FFIEC comes in and will examine the significant service providers, and now they're proposing to give copies of those exams to hundreds of bank customers of an individual service provider. That's just going to engage the service provider in talking to all of its customers as opposed to solving the problem with the regulator. The system needs to be rethought. It needs to be worked out. There are three ways that you can go at fixing the regulatory burden problem. We've talked, the congressman has talked about it, Tom's talked about the legislative way, but there are two ways you could approach things before you get to legislation, and they're quicker and they're easier. First one is the supervisory tone that comes from the regulators, that comes from the examiners. As I pointed out to Congressman Leutkemeyer, an examiner today would have written up his father's bank for illegal branching. You don't really have to do that. You know, you can back off the aggressiveness of the individual examiners to the point where they're looking for real problems, not micromanaging the institutions. Two, there is regulatory discretion in the agencies on a lot of issues. The capital issues that Tom Honig has talked about, most of that doesn't come out of statute. It comes out of rules that the regulators wrote. They can fix those things. The broker deposit definitions that are a problem at the FDIC could fix those things. They don't actually even have to do rules on that because they never wrote rules. They just wrote hundreds or scores of letters. So you only have to get to legislation when you find that the regulator's discretion is constrained by current statute. That's going to happen, but that's a longer game, and there's a lot you can do before you get there. There are a number of provisions in 2155 that are telling regulators how to exercise discretion that they already have and telling them to cut it back. You don't really have to do that by legislation. They could cut it back on their own. Two areas that I think the real focus should be on in this. I've mentioned one of them already is the service provider problem. I think the life of community banks depends on that. The other thing I think is important is the community banks' ability to raise capital in their communities. And Tom has pointed out the difference in capital costs. The community bank is typically looking at a different market than the Wall Street Bank is looking for to get that capital. There is an exception in the Bank Holding Company Act. The Bank Holding Company Act only applies to companies, but an individual is not a company, and an individual can own a bank and it can own a non-banking company, and that is typically in communities a source of capital to those institutions. That exception to the Bank Holding Company Act is being challenged in some litigation in Tennessee right now, and that needs to be preserved. We also need to think about whether you really need the separation of banking and commerce in banking organizations at the community bank level. If we're worried about aggregations of economic power, does it happen when the bank is below 10 billion? Maybe it does if the partner is big enough, but there may be a system to make it easier for community banks to raise capital, as well as systems to make it easier for community banks to operate and comply with current rules. Thank you.
Thanks, Sally. And our last panelist, which is a courtesy to let her go last so she could hear all the points that everybody made and amplify on those, or tell us we're crazy.
To tie it all together. I don't know.
Let her. Anyway, Rebecca,
Thanks, Paul. So interesting sitting here this morning. I'm in my first week as president and CEO of ICBA, day 3, but who's counting? Tasked to lead an organization whose mission is to create and promote an environment where community banks flourish. Not just survive, not just thrive, but flourish. It's also an interesting day as I sit here, May 9th, 1930. This is something, Dick, to add to your history book here. May 9th, 1930 was the formation of the Independent Community Bankers of America. 28 bankers gathered in Glenwood, Minnesota to fight back against the stranglehold that several of the national banks had in Minnesota and what they were doing to go around and leverage their ability as sort of that banker's bank, as I would refer to it today, to take over, consolidate, own, and thrive. And several of those banks had come out and said, you know, by the end of this decade, there will be 2 banks in this Federal Reserve District. Those 28 bankers felt quite differently about that. And I'm struck with the concept of the more things change, the more they stay the same. Because as I'm posed with this question, will the tradition of community banking survive? For me, it's a resounding yes for many different reasons. First and foremost, as Tom talked about, it is a very viable model. But for me, it goes way beyond that, because there is this ideological belief or passion that exists within the community banking realm that is almost hard to describe. And so as I think about it for myself as a community banker who ran a family-owned bank for the last 20 years, where does that come from? Well, it comes from the reality is, as a community banker, you see firsthand each and every day the impact that you have in the community. And you see that impact, and as the Congressman talked about, the growth of that community in many cases is dependent on what that bank is able to do. And that responsibility and the growth of your charter is dependent on the growth of the community. So that business model is dependent on making the right decisions that foster growth, that lead to economic development, that allow that bank to thrive. So it's a fascinating concept in terms of small business supporting small business that ultimately is dependent on a local economy's unique challenges and opportunities. And so we asked the question today, and the Congressman mentioned this, and he mentioned that 50% of small business loans are made by community banks. It's actually 60%. 80% of all agricultural loans are made by community banks. And why is that? Well, it's 2 reasons. One, the community banks provide a competitive product. They have relationships with those business owners, and they know what those unique needs and challenges are within that community, within that small business, and in many cases watched that business grow and evolve over time. And so they have been able to meet that need. The second is, in many cases, they're going way beyond the traditional underwriting guidelines that bigger bank may follow, that still looks at the ability of that business to function in the future. and takes things that are way outside those guidelines of a pro forma and a business plan to say, what impact can this have and what is the potential? For me, that was an excavator that got a large project. It was way beyond his financial capacity to get bonding. But we knew that person would be able to produce, had a good plan, and we invested in his ability to do that. For us, it was a lot of sustainable, non-traditional type construction. We have a borrower that I worked with for years whose building materials were beer cans, tires, dirt, glass, and built things called earthships, which today is a form of architecture that's being used around the world to go into communities of devastation and use what's on the ground to build houses. That is the core of the community bank business model. And so for me, as I think about what the future means, those things don't change. Those needs, the needs of the entrepreneur, the creative ideas in which our nation's economy is built, will always exist. And so the need for a community bank to be a player on the ground to meet those needs will continue to be there. Are there challenges? Oh, yes. Are we seeing disruption and consolidation in this industry more than we ever had before? Yes. But as we go through and look at what those challenges are, I remain fully committed to the thought that there is work that can be done to change that. The fact that we have a bipartisan bill in Congress where the heart and the reason the bill is getting through is because it is doing so much for community banks tells me something. As I think about the future for community banks, achieving proportionate regulation and leveraging this concept of innovation to succeed will be the drivers. And so what are we doing there? You know, Ollie raised this concept of innovation, and we've talked a lot this morning about technology and how that plays in within the community bank business model. And for me, there's a tremendous amount of opportunity here. And it's also something that community banks have been doing forever. You know, we talk about fintech and we think about all the cool new things that are engaged in that. But once upon a time, ATMs were fintech, right? Financial technology. I think about the evolution and how we've grown, and today it's commonplace for community banks to offer the mobile banking products, the person-to-person payments, the ability to engage 24/7 with that bank, and at the same time use that phone to call your community banker, not the 1-800 number, and engage in a conversation when you need it, as you need it. And that physical presence, that core of relationship banking of community bank does, and that ability to leverage technology innovation will allow that model continue to thrive. There are some challenges there. As we think about this evolving world of fintech where there's been incredible capital and investment to create these new ideas, there is the concern that we become non-bank providers within that fintech industry, and how that is appropriately regulated is a question that we're really trying to ponder. How we create opportunity for fintech partnerships with community banks in the regulatory environment in which we operate is a challenge. And how, as we think about the dependency, and Ollie talked about this, that community banks have on their core service providers, and how we are able to bring new things in. The way I think about this is so much of what I used to do as a community bank was dependent on a behind-the-scenes operating system, right? You know, it manages the deposit accounts, it tracks the loans, and it allows me to offer the mobile banking, the technology. But anything that I want to do to tweak it, to make it unique to my loan products or what I was offering within that community bank was an add-on. Because in the world of the core processors today, there's a very small handful of them. And so they're offering a service that has to work for 1,000 community banks. And every single one of those is a little bit different. So if I wanted to add something that was a little bit different, one, it had to be designed, and there was an incredible price tag, And then that add-on is not necessarily fluid in terms of how it flows through. So as you look at all of those barriers to integration to new concepts, it is something that needs work. And we need to think about how we're able to get creative and operate within this environment of dependence on the technology providers and the regulatory environment in which we operate to try and find that fine line there. At ICBA, this is a core part of what we're doing. We have a chief innovation officer that's looking for those opportunities for partnership. We've offered a fintech roadmap for success to help us try to figure out how to navigate and answer some of these challenges and find and leverage those opportunities. ICBA is engaging with the core processors and has put out a best processes guideline and continuing to engage in that dialogue. So there's a lot of work being done at the association level to ensure that we're able to tackle these challenges so that each one of the 5,700 community banks have the opportunity to leverage innovation and bring that into our environment. So then we think about the regulatory realm. And as we continue to find that balance, and someone talked about it earlier today, what banks do is manage risk. Now, I grew up in a community bank. My father was the president and CEO, and my mom was the HR director. A lesson I learned early on was decision-making and evaluating risk. And you evaluate risk not just on a model, not just on known quotients, but in everything that has been built over time. And you can't replicate that. And it works. And so how we structure this regulatory environment to find that balance, and that, I fully agree, is where it gets difficult. Because part of it is an art, not a science. And you can't regulate art. But how can you create that environment for flexibility and opportunity for economic development and growth? And so as we think about those challenges, it's ensuring that we have that ability to proportionately operate within this environment. And as we think about all the headwinds, and the Congressman talked about things like the BSA and AML framework, something that our community banks are being tasked to be the law enforcement officers. The amount of time that's spent on it is crazy. Now, let me back up for just a minute. Every community banker out there wants to ensure that their community is safe and that the bad guys are being found, but there has to be a more efficient way to go about it. As we think about this regulatory framework, it's acknowledging that there is that desire, because at the end of the day, when we go back to the quotient around risk, in a community bank environment, who's taking the risk? It's the owners and the investors in that community bank. 100% of what we've invested is at risk. And so as we find that environment to be able to proportionally balance and manage that risk, that framework, and that ability to ensure appropriate capital and rules within that sector will be so important. And so, as we go in maybe to some discussion on these topics today, as I think about the future for community banking, I think there is a very clear path forward. And I think part of that path is just this commitment and realization of the importance of that community banking model, the viability of that model as it continues to evolve over time, and the opportunity to engage in something that is historically shown its ability to thrive even in times of great disruption. So I look forward to your questions.
Thank you, Rebecca. So before we turn to the panel for some remarks on reactions, first couple of thoughts. When Dick mentioned that it's people that need money that start the banks, not always the ones with the money, he reminded me of there's a famous railroad in Switzerland. I was lucky enough to live in Switzerland and go back and forth a few times over my career. And it goes from Grindelwald to the top of the Eiger. It's actually called Jungfraujoch. It's the highest railroad in Europe. It goes through the mountain, and some crazy Swiss engineer decided about 125 years ago that he wanted to build a railroad from the bottom of the mountain up to basically the top of the Eiger. And you know what the first thing he did? He founded a bank. Because he needed money for his railroad. Money. And the second remark, when Congressman Leutkemeyer said, where do all these paperworks go for the FISA? I have a hunch. It's the last scene in Raiders of the Lost Ark, where they're taking the Ark in the box and they're putting it in this huge government warehouse. I think that's the FinCEN warehouse for file keeping. But Dick, do you have any reactions to what you've heard this morning?
Well, Rebecca's remarks resonated with me because, I read, like in the early history of American banking, that story was repeated over and over, that, the bank was founded and the community grew, and, it's kind of romantic, or I don't know what we'd say, but, Elizabeth Warren, I think, thinks that all bankers are sort of crooks or something like that, or would-be crooks. And so the only way you can prevent them from doing bad things is to have this extreme heavy regulation. My own view is that I've established a sort of hypothesis that a lot of modern economies grow because they modernize their finances first. That the U.S. is a classic case. I do a lot of writing about Alexander Hamilton, who modernized our financial system in just a few years' time at the beginning of the country. And then, of course, the U.S. grew like Topsy, so much so that, I spent a good bit of my life thinking that the England was the first country to industrialize and grow. But now some of the latest economics research is showing that the U.S. was actually the first country to have modern economic growth starting in the 1790s. Modern economic growth being defined as 1% a year real per capita growth. England apparently didn't do this until the 1820s or 30s, whereas the U.S. started in the 1790s. And it seemed to happen at the same time that we modernized our finances. So there's a lot of great stories about the importance of finance to economic progress and growth. And when Rebecca was describing what the community bankers are trying to do, that just resonated with me. We need to think of banking more in those terms and allow it to flourish.
Well, I'd echo that. I would say, first of all, that the United States has been unique in the sense of its banking structure, with free entry over a long period of time, and we've benefited. We've had very large banks all the way down to small for most of our history. It's allowed us to finance large transactions, small entrepreneur transactions, and that is a very strong advantage for any industrialized or hope to be industrialized country. And I think we need to keep that in mind as we consider the next phase for the U.S. banking system and how the community bank and how banking in general is going to develop. So it's a big challenge, but also I think a real opportunity for the U.S. in the future. Thank you.
Holly?
I'm going to add another technical comment. We've had some discussion here about the AML problem, about banks being required to police the community, and you have to, a couple of thoughts on that. One of them is, early on when we were bringing, I lived through sort of the growth of this process in the early 90s when we were worried about financing the Medellin drug cartels and so on. And we were discussing an AML rule at the board table, and one of the governors pointed out, and he said, how much is this going to cost the banking system? And we didn't know, and he said, but you take that number, and that's a tax on the economy. It's going to be passed on to the rest of the economy. It's just like a tax. Take that number and say, is this the way I want to spend that much money on law enforcement? And would you do this rule as the result of that? No way. Is it a cost-effective approach? Probably not. The other thing is I spent a lot of time in those days talking to the people who were promoting anti-money laundering, and they would explain to me what they wanted to do, and then I would explain to them how I would get around it if I was on the other side. And they would say, yeah, but we made you get around it. Yeah, but you cost the financial system a fortune to make somebody get around it that they're gonna figure out how to get around in a long time. We're spending an awful lot of money on AML. We're imposing huge fines on people. If we're going to enforce laws, let's enforce laws, but the idea of creating the banking system as a law enforcement agency, and we're hearing more of this now in other contexts, but the idea that they're a law enforcement agency, I think, is misguided, and you need to step back and say, are we spending our money the best way we ought to be spending our money to achieve the goals we want to achieve?
Rebecca, last thoughts before we go to the audience?
Just thinking about this concept of folks who are wanting to borrow or those that start banks, and it's that that desire, that vision of something being possible, and I think that's one of the big challenges facing us these days is that barrier to entry for de novo formation. As we think of new birth within an industry, that's critical to the industry's survival. And so how, from a regulatory perspective, knowing that full well a lot of the challenges over the last several years have been the economic environment in which we're operating, how do we ensure that communities of all size, whether it's metro or rural, have proportionate options for entry into the market to be able to create and charter these community institutions where a need has been identified, and if not for that local group of investors, no one else will be there to serve that need. Our bank's a classic story. My grandfather was a third-generation Tausenyo, born and raised in that community, came back home after getting an education and wanted to start his own business, had nothing to his name. Got 300 people together, and after 10 years of fighting for the charter, they opened the community bank. That legacy and that opportunity should be an option as opposed to a barrier within an appropriate framework.
Thank you. We'll turn it over to the audience. Do we have some questions for our very knowledgeable panel? We'll start over here with you. Go ahead. Grab the mic. Yeah, and we'll come to you next. No? Okay.
Thank you. Norbert Michel, Heritage Foundation. Thank you, guys. Great panel. I have kind of two questions, really. One is regarding the QM, the qualified mortgage. Both the Choice Act and the Senate bill have provisions that say if you're a bank and you're holding you're holding the mortgage instead of securitizing it, it's QM. The Senate's for smaller banks. The choice would have been for everybody pretty much. But my question is that still a viable model? In other words, are banks actually interested, especially smaller banks, are they actually interested in holding those banks? And do you think that will be a beneficial change? My other question is, I'm just going to go two questions. My other question is regarding regulatory discretion. Congressman Davison has a great story about when he was running a bank. The regulators came in and literally told him he was doing too well. They're getting nervous. He should go start playing golf and slack off. Without a legislative fix, and Ali, you touched on this, but without a legislative fix, how do you stop, in the system that we have, how do you stop regulatory agencies or supervisors from coming in and saying, you're doing a little too much commercial real estate, you need to back off? Things like that. Micromanaging the institution. Is it really practical to think that we could stop that sort of thing from happening without a legislative solution?
Let's hit the QM one first. Is that going to be very helpful to community banks?
Yes. And each bank is different in terms of how much they continue to hold, and for so many of them, it's a question of just interest rate risk. But for those that are willing to hold that asset and want to do so, to have that potential unknown of the qualified mortgage is taken off the table in terms of added regulatory or legal risk in the future, makes it a much more viable option. And so I think that it is significant to have that flexibility.
So, Ali, how do we control the regulators without legislation?
Well, first of all, what's the legislation going to say, and how's it going to work? That's where I start. I'm not sure how you control it with legislation. I think it's something we got to think about. We go through these cycles. This is not the first time we've been through this cycle. after Sedition in December of 91, which was the response to the Thrift crisis and the failures, real estate-related failures in the banking system in late 80s, early 90s, there came back a tale to Washington, whether it was true or not, who knows, that banks were not making character loans, i.e. loans, community banks, the only people that make character loans, but they loans based on the banker's knowledge of the capabilities of the individual running the business and their confidence in that individual. And they came under the word character loans, and the story came back, this is a problem. Character loans are being shut off by rigid regulatory requirements. You got to back off. And at the Fed, at least, I think in the other agencies, word went out to the examiners to back off, and we stopped hearing that complaint. Did it work or not? You know, I don't know any statistical means. But I think you've got to look at all avenues. If I knew how to draft legislation that I thought would work, I would support it in a heartbeat. I think it's difficult to do it that way. I think the best thing you could... It's the old Brandeis quote. Sunlight's the best disinfectant. The electric light is the best policeman. We shine a light on the issue, and the more we shine the light on the issue, I think the more response we're going to get, and people are going to look at solutions and think of solutions. But I think it's a real problem.
Tom, you were in the belly of the beast for 26 years. How do we control this?
Well, I do believe in the rule of law over the rule of individuals. And so I think there needs to be very strong, clear, but simple laws. And there's no substitute for judgment over time. And I've heard stories like yours as well, but I don't think anecdote is data. And I think generally examiners are sensible. But here's the problem with laws that are so refined that it leaves no discretion. And that is, one of my major concerns is with fair lending, for example. Disparate impact sort of thing. It's, if you have a sense as an examiner that, or there's any evidence that there might be a pattern of practice, it immediately has to be referred to the Justice Department. No discretion. It's one time, inadvertent, doesn't matter. And I tell people, you know, imagine yourself being referred to the Justice Department, and the examiner says, look, I have to do this, but don't worry about it. Most of those come back to us without action. It's, you know, you don't sleep until it's back, if it gets back. So you have to be really careful. But I do think, having, you know, to Rebecca's point, if I have enough of my investor interest at stake, they will be very, shall we see, play a very important oversight role. If they don't have something at stake, then guess who does? The Fdic and the regulators, because we'll pick up the ticket and so forth. So those are the sorts of things that I think you need to focus on under the rule of law, and not try and fine-tune everything. You will wrap yourself around a pole pretty quickly.
Go to another question. Please.
Basically, mine was very similar to the gentleman beforehand. I was going to ask Tom, again, sitting at the top of the food chain, if you will, within the agencies, is there a means by which you can kind of change the tone and tonality within that agency to be a little bit more progressive, a little bit more, I don't want to say lenient because that sounds negative, but I'll give you an example. I was working on behalf of a client, and I asked a Fdic, a senior member of the Fdic, when we might be able to expect a response so I could set the institution's expectations. And the individual told me, we're the Fdic, we work on our own timetable. And so I'm trying to find the cultural change. I'm sure some of it will come with agency leadership, but, you know, and Rebecca, you might be able to say, you're dealing with the three days into it, you're setting an additional culture within ICBA. So I'd just be curious as to ideas from the top.
Well, I understand your point, and I've seen some of those actions. And, of course, the tone of the top matters. And so when you have changes in administration, you're going to have a change in the tone of the top. So I think that is part of the process. Also, though, that means you are going to have changes in that attitude, and I think that's where some of the inconsistency comes in. Does give me concern, and that's why you want strong basic rules of law in place. The other thing, though, is it's the events themselves. When you have in the 80s over 1,000 banks failing, you get it was all the examiner's fault, so then you get the overreaction of that. And then this last crisis, 500 banks. Now we're swinging back, and we will see that. But I don't think you'll ever see that completely go away. I am worried, though, that it's been made over and over again. When you have the Dodd-Frank Act, and it's so-called 2,300 pages, but then the rules are tens of thousands of pages. You are going to, it's like putting a pillow over somebody. You put it over lightly, yeah, it heats up, but when you put it down on them, you kill them. And that's what I worry about when you have tens of thousands of pages of these regs, and that's where that can go away. I'd rather leave a lot more discretion, and there will be these stories, than so many regulatory rules versus law that just smother the industry. And that's our biggest danger, I think.
One possible way, and I don't know, to handle this is not that Congress writes the rules, but if a regulation comes out, isn't there some Congressional Review Act? If it's just too complicated, Congress says, no, go back, do it again. Yeah. I mean, and they haven't done that. I mean, it's just the volumes and volumes of things that come out are it's just unacceptable. Congress doesn't have the power to oversee whether the regulatory community's doing what the rules say anyway, because they're too complicated for any of them to understand unless, they don't have the staff, they don't have the expertise. At some level, they ought to step up and say, too complex. Go back, figure out something simpler, and come back and talk to us. That's really, not that they write the law, but they kick it back to them and say, this isn't what we want. We're not okay with this. I think something like that. I don't know, Ali, is that legal?
Yeah, it is. The Congressional Review Act, which has been used, I don't know, more than a dozen times in the current administration. It's been used once before, and usually you head off that process through, if the president will sign the bill, they control the administration and they can pass the word down not to do that. The problem, I think you put your finger on the problem. The stuff is so complicated. Some of the Consumer Bureau actions have been overturned under the Congressional Review Act, and some of the other agency actions have been overturned under the Congressional Review Act. But one of the consumer ones was overturned this week. I think the regulators, they go up to the Hill and, for example, they explain the bank capital rules and the stress testing and all that. And it's gotten so complicated that nobody listening to them knows what they're hearing or whether it makes any sense. And somebody's got to step back, and I thought there was a false sense of precision in risk-based capital when it first showed up in the early 1990s, and the way it's evolved since, I can't imagine that those numbers are right, and they're taxes. And I don't know how we get back other than you keep pushing at the issue and make progress by inches, not by yards.
Michael Michaud with KBW. I had a question for Mr. Honig or any of the panelists about there's a trend of banks considering dropping their bank holding company, and some are saying that's one way to alleviate burden. You decrease or you get rid of maybe one of your regulators if you're not a Fed member bank. And so I'm wondering if you think that's a viable way for banks to decrease regulation, or if there's a possible threat to systemic risk by a number. I mean, Zions is the most famous one doing it right now, and they're not really a community bank, but maybe across the community bank industry, or Ms. Rainey, if you think so, if that's an option. Just want to get your thoughts on that.
Well, I think the purpose of the Bank Holding Company Act varies, but for many of the community banks, it's to allow you to lever your company to get ownership of the bank, and if you don't have a debt against that, not having a bank holding company is not a systemic risk issue at all. For some of the larger ones, the holding company issue is more complicated because if you have a holding company that has a broker-dealer as a subsidiary and a bank as a subsidiary, to merge those means you even do it with a holding company, but to merge it, you are bringing the subsidy, the insurance program, the access to liquidity and the discount window, you're broadening that coverage to this other group of institutions, and therefore you are adding to the systemic vulnerabilities choice you make.
You can't even merge the broker-dealer and the bank. Because
you cannot merge them,
yeah,
but they're under a holding company.
You can put them under a holding company. You can't merge them because they live under different insolvency regimes.
However, we all know that if you are affiliated with a large commercial bank and the broker-dealer gets in trouble, if you're going to bail out a broker-dealer when it isn't associated with a bank, you are definitely going to my point is you're extending the systemic risk problem when you do that.
But that's
a choice.
But that's with creating a holding company.
Right.
Is it a systemic risk to not have a holding company? I don't think so.
But
yeah. Yeah.
If it's a broader trend.
I don't see a systemic risk.
It's been in the news.
I just don't see it.
And it's been played up. I think in S-155, isn't there a provision where the small holding company provision of the law, they increase the size of the holding company, and that gives the smaller community banks a lot of room out of some of these reporting requirements and other things. So the Senate bill actually will help stem the tide in some way for the smaller community banks if they think the regulatory burden is too great. Once they get that through, that should help a bit.
When I talk to people who want to form banks for various reasons, and new banks, the biggest deterrent, the killer, is usually the Holding Company Act application of the Holding Company Act to any company that's investing in it, even if they're not actually going to run it. You know, the Fed's control rules are so broad that they pick up control and they create a bank holding company when control of the company doesn't really exist. And it's a big deterrent to bringing capital into the system.
Question here?
Hi, Jim Chesson, the American Bankers Association. We've touched a little bit on fintech, and like ICBA, ABA spent a lot of time because it is critical for community banks. Just to narrow the question down, though, Arizona recently passed authority to create a sandbox with the support of the Attorney General. Illinois has done the same thing. New York is likely to do it. Other states are doing it. So I'd be interested in reactions of the panel about how that might help or hurt community banks, what it means for the future, and whether or not a national sandbox would be appropriate to really facilitate banks being involved in facilitating innovation.
What question I always have when I hear the sandbox advocation is, what is the sandbox going to let you do? Is the sandbox going to let you, as a lender, not comply with the Truth in Lending Act?
CRA?
Well, CRA is a banking issue, but I can be a lender under state law, but I have to get a state license, and I have to comply with federal regulatory requirements. Which ones of those are we going to dispense with in this so-called sandbox? And depending on how you answer that, the advantages or effects of the sandbox are different. The idea that you're going to let one group of lenders treat consumers unfairly or if ignoring truth in lending. If truth in lending is a problem, fix truth in lending. You know, and truth in lending is a problem, but fix that. The idea that some people can just ignore it and compete I have a lot of I just don't see how that works.
I thought there were also problems with not having a brick and mortar footprint. So, you know, if you take deposits and you make loans, what community do you serve, and how do you satisfy?
That problem's been around for some time.
So how does the sandbox deal with that?
I don't understand how I don't know what the sandbox does for you there.
I don't understand the sandbox concept either. I mean, if you want to allow a bank to do something, allow it to do something. Across, or if you want to reduce some kind of a reg that affects it, then reduce it. But the sandbox becomes just, I think, a point of contention within the industry and among just trying to figure out what it is you're going to regulate or not regulate. I think it'd be really confusing.
If you could do anything, there may be some room in state licensing laws for lenders and money transmitters. We're seeing those laws, which aren't banking laws, applied. The only thing I can think of that's going on is the states are trying to generate licensing revenue. You know, they're going after people and asking them to become licensed when they're not doing what the law is designed to deal with.
Is the sandbox really aimed at cryptocurrency trading? Maybe you could tell us a little more about that. Is it really about banking, or is it really about licensing cryptocurrency brokers and as a money transfer agent or something?
Yeah. Well, I mean, there may be some of that. I mean, my sense, and maybe comes back to Ollie's question, I think what's attractive about this, and there's different ways to do it. The UK's got one, Singapore's done it, but I think the idea is, under the current regulatory scheme for banks, it's very hard to do any kind of innovation because it gets shut down early. And innovators, banks can't, move fast and break things. It doesn't work that way. But there's got to be a way to do an iteration to be able to see if products can work and do it in a way that doesn't, it's not trying to get outside of consumer protection, but a way to try to do things that are iterating faster and getting products out to market that might be squashed early on by the regulators. And I think that's one of the fears that community banks have, is they can't do that innovation because they get shut down quickly. So part of the question is whether or not you can do this, and the experience in the UK seems to be that there are products that get released to the market or able to be scaled and do it more quickly through the financial system that may not be possible in the United States. So yeah, can it be crypto? Maybe. That isn't the discussion that I've heard with a lot of ones.
Lydia? Over here, please.
Hi, Lydia Mashburn with the Cato Institute. I had two questions. One is, in terms of moving to simpler regulations, what does the panel think about the regulatory off-ramp proposals, the ones where if banks hold higher capital, they can get out of a number of regulatory burdens? The Choice Act, of course, has a very more comprehensive version of this off-ramp. The Senate bill has like a mini one for community banks. So I'd be curious to get the panel's thoughts on that. And secondly, speaking of the Senate bill, there's a lot of regulatory relief for community banks in that bill. It is targeted to that particular group. Are we at all concerned that we are creating a dual-class banking system by providing this regulatory relief? By which I mean, are we creating a system where the big banks can keep getting bigger and community banks effectively hit a ceiling by which they don't want to grow any further because they're going to get hit with more burdens? And what does that mean for the future of banking and how they serve our economy in future?
You want to take first crack, Rebecca?
Sure. So, it's an interesting question as we think about the perception of limits on growth. I think there's an opportunity, though, and for me, and Tom's talked a little bit about this, but it's thinking about how regulation is proposed or drafted to be specific to that business model. And so if we are looking at a traditional community bank that is engaging simply in commercial banking activities, how do we allow that proportionate regulation to exist? And so the the only mechanism up to this point that has existed really has been a size threshold. But it does create challenges over time as we think about where is that line in the sand? Is it 1, 10, 50, 250? And sometimes it depends. And so I think there's a lot of work that needs to be done within that arena so that we aren't disincenting this concept of growth, because we do want community banks to grow over time. So that would be my 2 cents on that one.
We're in a world today where asset size, consolidated asset size, is used as a threshold trigger for significant changes in the regulatory structure. And it's arbitrary, and it's capricious, and it bears no resemblance to reality, I think, as Rebecca said. What's the business model? You see a different approach. The Fed came out with one of their CCAR rules a while ago, and they created a different structure for what they called a large non-complex holding company. And they started to look at what the business model is. And I thought that was moving in the right direction. I actually thought that's the way the 165 threshold would have wound up in 2155, and then we came back with a new set of numbers. And I think consolidated asset size is not the way to do it. I have run into banks at virtually all levels that are concerned about growing over that size, and I have run into banks, for example, that have found themselves over the 10 billion level going into regulatory shock. Is the whole attitude of the examiners changes. And they were prepared for the written rule change. They weren't prepared for the change in level of supervision they were getting. And that system isn't right. But we have multiple bank business models in the United States. And it's not just 2. I think there are a number of them, and the regulatory and the supervisory system needs to be tailored to the models. Not to sizes, and that hasn't happened effectively over the years.
I agree. I think there are many models, but there are 2 principal models, and I think there is a dual system already. There's a universal bank model. There's like 8 institutions, and then there's everyone else. I have no use for threshold sizes, because when you look at the issues that are involved with these so-called universal banks, and then you go down below that, most commercial banks have far less than 10% of their assets in trading assets. The largest GSIBs have 30%, 40% in some cases. Everyone else has less than 5%, most around 1%, and they're for accommodating customers or hedging their portfolio. Perfectly business. So for me, you take the GSIBs and you separate them out, and then everyone else. And the CCARs, the stress tests, those are things that if you had a higher capital threshold, which most of the non-GSIBs have, then you allow them the freedom to make choices. It becomes much less of an issue around liquidity and so forth. It's simple. It's when you take this 8 and you take the Dodd-Frank that applies to that, and then you apply it to everyone else, that the suffering, I should say the smothering, takes place. And that's what you really want to avoid. And it can be done. It can be done.
So I'm going to have to pull the plug on all of this. We're running over time. First, I want to say, Rebecca, Ollie, Tom, Dick, thank you so much for being on the panel and sharing your expertise. Rebecca, it's a pretty good 3rd day on the job. I hope it keeps going as smoothly. And thank the audience for your questions and for staying, and thanks for coming. Hope to see you again here at AEI.